Welcome to the show where you'll learn how to invest in mortgage notes, the savvy real estate investor's secret weapon to create cash flow without tenants and property acquisitions for pennies on the dollar. My name is Robert Haitha, founder of Fix Notes, and my mission is to make note investing ethical, profitable, and accessible for you. In every episode, we're democratizing the industry to put these powerful Wall Street assets into the hands of Main Street investors like you. So without further ado, let's get into this show where you're in good hands with my AI clone. Let's go. This program is for informational purposes only and should be independently verified before taking action. Most investors are trained to think like consumers, not banks. That's why mortgage notes are overlooked. When you think of real estate investing, you picture houses, tenants, flips, and renovations. The note business is different. It's not about owning the property. It's about owning the paper, the debt secured by the property. And that's where most investors miss the point. When you own the mortgage note, you become the bank. You don't deal with clogged toilets, late night calls, or township inspections. You don't argue with contractors or chase down rent. You collect payments. And if the borrower stops paying, you have legal recourse and a property secured by a first or second lien. In many ways, it's a cleaner, more scalable business model than traditional real estate. But most investors never get this far. They stop at rentals or flips because that's what's marketed to them. Real estate TV doesn't feature note workouts or servicing transfers, and schools don't teach finance from the lender's perspective. So the note space stays relatively quiet, even though it's one of the oldest financial systems in existence. Every bank in the country relies on notes for profit, so why wouldn't you? Let's look at some of the reasons this asset class is ignored. First, it's not visible. When someone buys a rental, you see it. You can drive by. Notes are behind the scenes. A performing note looks like a regular mortgage until you realize the original lender sold it at a discount. That new investor now collects payments with none of the property headaches. That deal happened off market over a spreadsheet with servicing transferred quietly in the background. Unless you're in the loop, you'd never know. Second, there's a perception that it's complicated, and it can be if you're winging it. There's a learning curve, lien position, title review, collateral files, borrower outreach, but just like with rentals, systems can simplify everything. You don't need to be a legal expert to send a demand letter. You don't need to be a data scientist to analyze a payoff history. Once you know what you're looking for, due diligence becomes repeatable. The business is all about building efficient systems. Third, there's fear around defaults. Most people hear non-performing loan and think bad investment, but that's where the opportunity lies. Non-performing notes can be bought at a significant discount, and resolution strategies, reinstatement, discounted payoff, deed in lieu, can generate excellent returns while helping borrowers get back on track. In fact, many investors specialize in these resolutions and never take back a property. The key is leverage. Notes give you options. Let's compare it to rentals. If a tenant stops paying, your options are limited. You might lose months of rent, pay legal fees, and end up with damage. But if a borrower stops paying a mortgage, the note investor has legal rights built into the contract. The foreclosure process, while not fun, is structured and enforceable. And in most cases, you're not even trying to foreclose, you're just using that legal framework to create urgency and open a conversation with the borrower. Another advantage, entry cost. You don't need $100,000 to start. There are first and second position notes available for under $25,000. Some investors start with just one or two, learn the process, and scale from there. Others raise capital and build funds. You can go wide or deep. And because you're not limited by geography, you're not stuck in one overpriced market. You can buy a note in Ohio while living in California. The asset is paper. The collateral is real estate. Notes also shine in uncertain markets. When property values fluctuate, landlords get nervous. Vacancy, maintenance, and regulation all eat into cash flow, but the note investor still gets paid. Why? Because you're collecting debt, not rent. Even in a downturn, people pay their mortgages, especially when they've already defaulted in the past and gotten a second chance. Reperforming loans often have stronger payment behavior than brand new ones. So why are notes still under the radar? Because the big players want it that way. Banks, hedge funds, and institutional buyers have dominated this space for years. But the secondary market is massive. Thousands of notes trade hands every month, and more inventory is coming from seller financing, private lenders, and smaller banks. The opportunity is real, but you have to know where to look and how to position yourself. In the next episode, we're going to show you exactly that, how to find note sellers. We'll talk about going direct to source, building trust with sellers, and how to stand out as a serious buyer in a competitive space. You won't find these deals on Zillow. You have to earn your way into the market. Thanks for sticking around to the end, and thank you to my trusty Rabah and the Fixed Notes team for putting together another episode. If you want to learn more and hang out with the real, not AI version of me, join our free school community at school.com/fixnotes. That's SKOOL.com/FIXNOTES. In the meantime, we'll see you in the next episode.